Hi there. Welcome to PwC's monthly economic barometer for April. I'm Jonathan Westhead. Our barometer has continued to drop in March, this time by 7 points to reach +10, its lowest level since November 2016. Contrasting to a slight increase in confidence amongst Luxembourgish manufacturers, the ZEW index plunged from 29.3 to 13.4. In Luxembourg, growth was absent from the last quarter of 2017. In fact, we had a near stagnation of -0.1%. This means that year on year, the economy only grew 2.3%, equal to that of the euro area. This provisional figure is well below Static's latest forecast of 3.4%. This is largely explained by the contraction of the value added in terms of the financial sector, while employment in this sector grew by 2.8% in 2017. In fact, the Grand Duchy's economic growth was the topic of debate during the recent Economy Day, jointly organized by PwC and the Chamber of Commerce. The consensus was that Luxembourg should move towards a qualitative growth model, according to the Rifkin framework. We're joined now by our senior economist, Osama Al-Sabag, to discuss the principles of the Rifkin framework. Osama, thanks for joining us. Could you tell us a little bit more about the framework and what it entails?
Sure, Jonathan. The project Third Industrial Revolution in Luxembourg, inspired by Jeremy Rifkin, was launched in September 2015. The implementation of the Third Industrial Revolution facilitates the shift to qualitative growth based on technological progress, aggregate efficiencies, productivity gains, and intelligent management of resources. This qualitative growth enables responsible wealth creation with the goal of rendering our socio-economic model more sustainable by tackling issues such as poverty, unemployment, inequalities, loss of biodiversity, and climate change.
Thanks, Osama. Well, it'll be interesting to see how this develops in the coming years. In the Eurozone, political uncertainties following the Italian elections and growing tensions between the West and Russia have compounded investors' fears. The stock market shocks in early February also had a significant impact. The Euro stock index fell 4.7% in Q1 2018, its worst performance since early 2016. The near correction was principally related to inflationary pressure fears across the Atlantic, as well as protectionist threats brandished by both the US and China. Indeed, a trade war between these two powerhouses would inevitably have a major global impact. Finally, large tech companies are still uncertain about their fiscal treatment in Europe and the US. That's all for now. Thanks for joining us. We'll see you soon.